My name is Kim Lawson. I'm a senior tax analyst with the Small Business Self-Employed Division within the IRS. Welcome to Depreciation Basics. Depreciation is an annual income tax deduction that allows you to recover the cost or other basis of certain property over the time you use the property. This is an allowance for the wear and tear, deterioration, or obsolescence of the property. Depreciation is computed based on depreciation methods, recovery periods, service dates, and conventions set by the Internal Revenue Code, Section 168. Before we begin, we'd like to extend a welcome to any participants from the news media. If you are with the media, please send us an email message at sbsc.webinars@irs.gov with your contact information. Our media relations staff can assist in clarifying the discussion or answering any questions you might have following the presentation. Everything we talk about today, from forms, instructions, publications, and web pages, is available on www.irs.gov. For your convenience, we have provided you with a PDF file of this presentation to download, print, and take notes on. It includes a list of the majority of the resources we'll mention today. If you did not notice it previously, you will see a link to download the file on this webinar page. You can ask questions during the webinar by clicking the Ask a Question link under the PowerPoint window and selecting the Submit button. At the end of this presentation, a team of subject matter experts will respond to your questions. We will answer as many questions as time allows and ask that you limit your questions to the topics covered in the webinar today. Please do not ask questions about specific case-related situations. We simply cannot provide guidance for individual situations in this forum. Also, please avoid inappropriately disclosing any sensitive or identifying information about you, your business, your clients, or anyone else when you submit a question. Finally, I would like to remind our audience that the information contained in this presentation is current as of the date we filmed the webinar, and that it should not be considered official guidance. The program will be archived on our website at www.irsvideos.gov for later viewing. During this webinar presentation today, we will discuss what property can be depreciated, what property cannot be depreciated, when depreciation begins and ends, methods for depreciating property, basis of depreciable property, how to treat repairs and improvements, electing the Section 179 deduction, claiming the special depreciation allowance, figuring depreciation under the Modified Accelerated Cost Recovery System, or MACRS, additional rules for listed property, and basis of assets. So let's get started with what property can be depreciated. You can depreciate most types of tangible property except land, such as buildings, machinery, vehicles, furniture, and equipment. You can also depreciate certain intangible property, such as patents, copyrights, and computer software. The property must meet the following requirements in order to qualify for depreciation. It must be property you own. It must be used in your business or income-producing activity. It must have a determinable useful life, and it must be expected to last more than 1 year. You are considered as owning property even if it's subject to debt. You can depreciate leased property only if you retain the incidence of ownership in the property. If you lease the property from someone to use it in your trade or business for the production of income, you generally cannot depreciate its cost because you do not retain ownership at the end of the leasing period. However, you can depreciate any capital improvements you make to the property. The property owned must be used in your business or income-producing activity. If you use property to produce income, the investment income is taxable. If you use property for partial or business investment purposes And for personal purposes, you can deduct depreciation based only on the business or investment use. If you use part of your home as an office, you may be able to deduct depreciation on that part based on its business use. Publication 587, Business Use of Your Home, contains information to help you make this determination. You cannot depreciate inventory if it's not held for use in your business. Any property you hold primarily for sale to customers in the ordinary course of your business is not depreciable. The property must have a determinable useful life. This means that it must be something that wears out, decays, gets used up, becomes obsolete, or loses its value from natural causes. Your property must also have a useful life that extends substantially beyond the year you place it in service. Let's talk about what property cannot be depreciated. You cannot depreciate land because it does not wear out, become obsolete, or get used up. You can depreciate certain land preparation costs, such as landscaping incurred in preparing land for business use. These costs must be closely associated with other depreciable property, such as a building or other structure, so that you can determine the life for them, along with the life of the associated property. Accepted property is another form of property that cannot be depreciated. Tangible property placed in service and disposed of in the same year cannot be depreciated. Equipment used to build capital improvements. You must add otherwise allowable depreciation on the equipment during the period of construction to the basis of your improvements. We will cover this later on the discussion of basis of assets. Section 197, tangibles cannot be depreciated. These costs must be amortized. We will also discuss intangible property and amortization later in the presentation. You begin to depreciate your property when you place it in service for use in your trade or business or for the production of income. You stop depreciating property either when you have fully recovered your cost or other basis, or when you retire it from service, whichever happens first. Property is considered to be placed in service when it is ready and available for a specific use, whether in a business activity, an income-producing activity, a tax-exempt activity, or a personal activity. Even if you're not using the property, it is in service when it is ready and available for its specific use. Here's an example. You bought a machine for your business. The machine was delivered in 2013. However, it was not installed and operational until 2014. It is considered placed in service in 2014. If the machine had been ready and available for use when it was delivered in 2013, it would be considered placed in service in 2013, even if it were not actually used until 2014. If you place property in service in a personal activity, you cannot claim depreciation. However, if you change the property's use to use in a business or income-producing activity, then you can begin to depreciate that property on the date of the change. For example, you used your home for personal purposes for several years before you converted it to rental property. You can claim depreciation in the year you converted the home to rental property because its use changed from personal to income-producing at the time of the change. You can continue to claim a deduction for depreciation on property used in your business for the production of income, even if it's temporarily idle or not in use. For example, if you stop using a machine because there is a temporary lack of a market for a product made with that machine, you can still claim a depreciation deduction for that machine. You stop depreciating property when you have fully recovered your cost or other basis. You recover your basis when your Section 179 and allowed or allowable depreciation deductions equal your cost or investment in the property. There will be further discussion on the basis of depreciable property later in the presentation. You also stop depreciating property when you retire it from service, even if you have not fully recovered its cost or other basis. You retire property from service when you permanently withdraw it from use in a trade or business or from use in the production of income because of any of the following events. You sell or exchange the property. You convert the property to personal use. You abandon the property. You transfer the property to a supplies or scrap account, or the property is destroyed. You must use the MACRS under IRC Section 168 to depreciate most property. You cannot use MACRS to depreciate the following property: property you placed in service before 1987, certain property owned or used in 1986, intangible property, films, videotapes, and recordings, certain corporate or partnership property acquired in a non-taxable transfer, or property you elected to exclude from MACRS. We will discuss MACRS in detail later. To figure your depreciation deduction, you must determine the basis of your property. To determine basis, you need to know the cost or other basis of your property. The basis of property you buy is its cost plus amounts you paid for items such as sales tax, freight charges, and installation and testing fees. The cost includes the amount you pay in cash, debt obligations, and other property or services. Assume debt. If you buy property and assume an existing mortgage or other debt on the property, your basis includes the amount you pay for the property plus the amount of the assumed debt. For example, you make a $20,000 down payment on property and assume the seller's mortgage of $120,000. Your total cost is $140,000, the cash you paid plus the mortgage you assumed. Settlement cost. Basis of real property also includes certain fees and charges you pay in addition to the purchase price. For example, legal and recording fees, survey charges, and amounts the seller owes that you agree to pay, such as back taxes, sales commissions. Property you construct or build. If you construct, build, or otherwise produce property for use in your business, you may have to use the uniform capitalization rules to determine the basis of your property. Other basis usually refers to the basis that is determined by the way you receive the property. For example, your basis is other than cost if you acquired the property in exchange for other property, as payment for services you performed, as a gift, or as an inheritance. If you held property for personal use and later use it in your business or income-producing activity, your depreciable basis is the lesser of the following: the fair market value of the property on the date of the change in use. Fair market value is the price at which property would change hands between a buyer and a seller, neither having to buy or sell and both having reasonable knowledge of all necessary facts. Sales of similar property on or about the same date may be helpful in figuring the property's fair market value. Your original cost or other basis adjusted as follows: increased by the cost of any permanent improvements or additions and other costs that must be added to basis, or decreased by any deductions you claimed for casualty and theft losses and other items that reduced your basis. Here's an example. Several years ago, you paid $160,000 to have your home built on a lot that cost you $25,000. Before changing the property to rental use last year, you paid $20,000 for permanent improvements to the house and claimed a $2,000 casualty loss deduction for damage to the house. Land is not depreciable, so you include only the cost of the house when figuring the basis for depreciation. Your adjusted basis in the house when you changed its use was $178,000. That is $160,000 plus $20,000 minus $2,000. On the same date, your property had a fair market value of $180,000, of which $15,000 was made for the land. Remember, you cannot depreciate land. And $165,000 was for the house. The basis for depreciation of the house is $165,000, which is the lesser of the fair market value on the date of the change, $165,000, or your adjusted basis, $178,000. Generally, if you receive property in a non-taxable exchange, the basis of the property you receive is the same as the adjusted basis of the property you gave up. To find your property's basis for depreciation, you may have to make certain adjustments, increases and decreases, to the basis of the property for events occurring between the time you acquired the property and the time you placed it in service. These events could include the following: installing utility lines, paying legal fees for perfecting the title, settling zoning issues, receiving rebates, or incurring a casualty or theft loss. If you depreciate your property under MACRS, you also may have to reduce your basis by certain deductions and credits with respect to the property. We will discuss the basis for depreciation later. You must reduce the basis of property by the depreciation allowed or allowable, whichever is greater. Depreciation allowed is depreciation you actually deduct, from which you received a tax benefit. Depreciation allowable is depreciation you are entitled to deduct. If you do not claim depreciation you are entitled to deduct, you must still reduce the basis of the property by the full amount of depreciation allowable. If you deduct more depreciation than you should, you must reduce your basis by any amount deducted from which you received a tax benefit. If you improve depreciable property, you must treat the improvement as separate depreciable property. Improvement means an addition to or partial replacement of property that adds to its value, appreciably lengthens the time you can use it, or adapts it to a different use. You generally deduct the cost of repairing business property in the same way as any other business expense. However, if a repair or replacement increases the value of your property, makes it more useful, or lengthens its life, you must treat it as an improvement and depreciate it. For example, you repair a small section on one corner of the roof of a rental house. You deduct the cost of the repair as a rental expense. If you completely replace the roof, you capitalize and depreciate the cost of the new roof. Let's continue on with electing the Section 179 deduction. You can elect to recover all or part of the cost of certain qualifying property up to a limit by deducting it in the year you place the property in service. You can elect the Section 179 deduction instead of recovering the cost by taking depreciation deductions. The maximum amount you can elect to deduct from most Section 179 property you place in service in 2013 is $500,000. $535,000 for qualified enterprise zone property. This limit is reduced by the amount by which the cost of the property placed in service during the tax year exceeds $2 million. To qualify for the Section 179 deduction, your property must meet all of the following requirements. It must be eligible property. It must be acquired for business use. It must have been acquired by purchase. And it must not be property described later in what property does not qualify. Property eligible under Section 179 is tangible personal property, other tangible property except buildings and their structural components, single-purpose agricultural, livestock, or horticultural structures. See Publication 225, Farmer's Tax Guide, for additional information. Storage facilities, except for buildings and their structural components, used in connection with distributing petroleum or any primary product of petroleum, off-the-shelf computer software, or qualified real property, which we'll describe later. Tangible personal property is any tangible property that is not real property. It includes the following property: machinery and equipment, property contained in or attached to a building other than structural components such as refrigerators, grocery store counters, office equipment, printing presses, testing equipment, and signs. Gasoline storage tanks and pumps at retail service stations, and livestock, including horses, cattle, hogs, sheep, and goats. I will briefly touch on off-the-shelf computer software and move on to qualified real property. Off-the-shelf computer software placed in service during the tax year is qualifying property for purposes of the Section 179 deduction. This is computer software that is readily available for purchase by the general public, is subject to a non-exclusive license, and has not been substantially modified. You can elect to treat certain qualified real property you placed in service as Section 179 property for tax years beginning in 2010 through 2013. If this election is made, the term Section 179 property will include any qualified real property, that is, qualified leasehold improvement property, qualified restaurant property, or qualified retail improvement property. The maximum Section 179 expense deduction that you can be elected for qualified Section 179 real property is $250,000 of the maximum Section 179 deduction of $500,000 overall in 2013. Generally, qualified leasehold improvement property is any improvement to an interior part of a building placed in service before January 1st, 2014 that is non-residential real property, provided all of the requirements discussed later under claiming the special depreciation allowance are met. Qualified restaurant property is any Section 1250 property that is a building or an improvement to a building placed in service after December 31st, 2008 and before January 1st, 2014. In addition, more than 50% of the building's square footage must be devoted to preparation of meals and seating for on-premise consumption of prepared meals. Qualified retail improvement property generally, this is any improvement placed in service after December 31st, 2008 and before January 1st, 2014 to an interior portion of non-residential real property if it meets the following requirements. The portion is open to the general public and it is used in the retail, trade, or business of selling tangible property to the general public. The improvement is placed in service more than 3 years after the date the building was first placed in service. The expenses are not for the enlargement of the building, any elevator or escalator, any structural components benefiting a common area, or the internal structural framework of the building. To qualify for the Section 179 deduction, your property must have been acquired for use in your trade or business. Property you acquired only for the production of income, such as investment property, rental property, if renting property is not your trade or business, and property that produces royalties does not qualify. When you use property for both business and non-business purposes, you can elect the Section 179 deduction only if you use the property more than 50% for business in the year you placed it in service. If you use the property more than 50% for business, multiply the cost of the property by the percentage of business use. Use the resulting business cost to figure your Section 179 deduction. For example, you bought and placed in service an item of Section 179 property costing $11,000. You use the property 80% for your business and 20% for personal purposes. The business part of the cost of the property is $8,800. That's 80% of $11,000. To qualify for the Section 179 deduction, your property must have been acquired by purchase and not be acquired from a related person. Related persons must be determined at the time you acquire the property. For instance, Ken is a tailor. He bought 2 industrial sewing machines from his father. He placed both machines in service the same year he bought them. They do not qualify as Section 179 property because Ken and his father are related persons. He cannot claim a Section 179 deduction for the cost of these machines. What property does not qualify? Land and land improvements do not qualify as Section 179 property. Land improvements include swimming pools, paved parking areas, wharfs, bridges, and fences. Accepted property is another non-qualifying property type. Even if the requirements explained earlier under what property qualifies are met, there are certain properties for which you cannot elect the Section 179 deduction. See Publication 946, Chapter 2, What Property Does Not Qualify, for detailed information on non-qualifying accepted property. At this time, we will take a short intermission. When we return, we will pick up with changes for the 2014 tax year.
Hi, I'm Becky and I work for the IRS. For most small business owners, finding out that they're about to be audited by the IRS is, well, pretty scary.
Mila, what's so urgent?
It's from the IRS. I think we're being audited.
That's why the IRS developed Your Guide to an IRS Audit, a series of short video lessons to help take the fear out of being audited and to let you or your clients know about all the responsibilities and rights small business taxpayers have during an audit. To find Your Guide to an IRS Audit, go to irs.gov and type Audit Video into the search box.
Welcome back to Depreciation Basics. Let's jump right in with the 2014 changes. For tax years beginning after 2013, the increased Section 179 expense deduction limits and threshold amounts before reduction and limitation will no longer apply. Also, the definition of Section 179 property will no longer include certain qualified real property. Qualified motorsports, entertainment complex property placed in service after December 31st, 2013 will not be treated as 7-year property under MACRS. Qualified leasehold improvement property, qualified restaurant property, and qualified retail improvement property placed in service after December 31st, 2013 will not be treated as 15-year property under MACRS. The accelerated depreciation of property on an Indian reservation will not apply to property placed in service after December 31st, 2013. The 3-year recovery period for racehorses 2 years old or younger will expire for such horses placed in service after December 31st, 2013. We will now discuss situations affecting dollar limit. The general dollar limit is affected by any of the following situations. The cost of your Section 179 property placed in service exceeds $2 million. Your business is in an enterprise zone business. You placed in service a sport utility or certain other vehicles. Or you are married filing a joint or separate return. If the cost of your qualifying Section 179 property placed in service in a year is more than $2 million, you generally must reduce the dollar limit, but not below zero, by the amount of cost over $2 million. If the cost of your Section 179 property placed in service during 2013 is $2,500,000 or more, you cannot take a Section 179 deduction. For example, in 2013, Jane Ash placed in service machinery costing $2,100,000. This cost is $100,000 more than the $2 million, so she must reduce her dollar limit to $400,000. That would be $500,000 minus $100,000. You cannot elect to take expenses more than $25,000 of the cost of any heavy sport utility vehicle and certain other vehicles placed in service during the tax year. This rule applies to any four-wheel vehicle primarily designed or used to carry passengers over public streets, roads, or highways that is rated at more than 6,000 pounds gross vehicle weight and not more than 14,000 pounds gross vehicle weight. However, the $25,000 limit does not apply to any vehicle designed to seat more than 9 passengers behind the driver's seat or equipped with a cargo area of at least 6 feet of interior length that is not readily accessible from the passenger compartment. If you are married, how you figure your Section 179 deductions depends on whether you file jointly or separately. If you file a joint return, you and your spouse are treated as one taxpayer in determining any reduction to the dollar limit, regardless of which of you purchased the property or placed it in service. If you and your spouse file separate returns, you are treated as one taxpayer for the dollar limit, including the reduction for costs over $2 million. You must allocate the dollar limit, after any reduction, between you equally, unless you both elect a different allocation. If the percentages elected by each of you do not total 100%, 50% will be allocated to each of you. The total cost you can deduct each year after you apply the dollar limit is limited to the taxable income from the active conduct of any trade or business during the year. Generally, you are considered to actively conduct a trade or business if you meaningfully participate in the management or operations of the trade or business. Any cost not deductible in 1 year under Section 179 because of this limit can be carried to the next year. Special rules apply to a 2013 deduction of qualified Section 179 real property that is disallowed because of the business income limit. You can find information on special rules for qualified Section 179 property under carryover of disallowed deduction in Publication 946, Chapter 2. Now, let's discuss taxable income. In general, figure taxable income for this purpose by totaling the net income and losses from all trades and businesses you actively conducted during the year. Net income or loss from a trade or business includes Section 1231, gains or losses, interest from working capital of your trade or business, or wages, salaries, tips, or other pay earned as an employee. For information about Section 1231, gains and losses, see Chapter 3 in Publication 544, Sales and Other Disposition of Assets. In addition, figure taxable income without regard to any of the following: the Section 179 deduction, the self-employment tax deduction, any net operating loss carry back or carry forward, or any unreimbursed employee business expenses. In addition to the business income limit for your Section 179 deduction, you could have a taxable income limit for some other deduction. You may have to figure the limit for this other deduction, taking into account the Section 179 deduction. See Chapter 2, Electing the Section 179 deduction of Publication 946 for a complete example of this situation. You elect to take the Section 179 deduction by completing Part 1 of Form 4562, Depreciation and Amortization. If you elect the deduction for listed property, which I will describe later, complete Part 5 of Form 4562 before completing Part 1. You can elect to expense certain qualified real property that you placed in service as Section 179 property for tax years beginning in 2013. If you elect to treat this property as Section 179 property, you must elect the application of the special rules for qualified real property described in Section 179F of the Internal Revenue Code. To make the election, attach a statement indicating that you are electing the application of Section 179F of the Internal Revenue Code. The statement should indicate your election to expense certain qualified real property under Section 179F on your return. It must specify one or more of the 3 types of qualified property to which the election applies, the cost of each such type, and the portion of the cost of each such property to be taken into account. Also, report this on line 6 of Form 4562. Remember, the maximum Section 179 expense deductions that can be taken for qualified Section 179 real property is limited to $250,000. You can take a special depreciation allowance to recover part of the cost of qualified property placed in service during the tax year. The allowance applies only for the first year you place the property in service. For qualified property placed in service in 2013, you can take an additional 50% special allowance. The allowance is an additional deduction you can take after any Section 179 deduction and before you figure regular depreciation under MACRS for the year you place the property in service. See Publication 946, Chapter 3 for additional information regarding qualified property, special rules, and accepted property. Keep in mind, you can elect for any class of property not to deduct any special allowances for all property in such class placed in service during the tax year. To make an election, attach a statement to your return indicating what election you are making and the class of property for which you are making the election. Once you elect not to deduct a special depreciation allowance for a class of property, you cannot revoke the election without IRS consent. When you dispose of property for which you claimed a special depreciation allowance, any gain on the disposition is generally recaptured or included in income as ordinary income up to the amount of the special depreciation allowance previously allowed or allowable. The Modified Accelerated Cost Recovery System, or MACRS, is used to recover the basis of most business and investment property placed in service after 1986. MACRS consists of two depreciation systems, the General Depreciation System, or GDS, and the Alternative Depreciation System, or ADS. Your use of either the General Depreciation System or the Alternative Depreciation System determines what depreciation method and recovery period you use. You generally must use GDS unless you are specifically required by law to use ADS or you elect to use ADS. There are 9 property classifications under GDS. These classes are listed on Form 4562. See Publication 946, Appendix B, Table of Class Lives and Recovery Periods for more detailed information on property classes. Qualified rent-to-own property is property held by a rent-to-own dealer for purposes of being subject to a rent-to-own contract. It is tangible personal property generally used in the home for personal use, computers, furniture, and televisions. Let's do a brief recap. So far, we have covered what property can and cannot be depreciated, when depreciation begins and ends, methods for depreciating property, how to treat repairs and improvements, electing the 179 deduction, and claiming the special depreciation allowance. Let's continue with figuring depreciation under MACRS. The basis for depreciation of MACRS property is the property's cost or other basis multiplied by the percentage of business use. The recovery period of property is the number of years over which you recover its cost or other basis. It is determined based upon the depreciation system used. Under MACRS, averaging conventions establish when the recovery period begins and ends. The convention you use determines the number of months for which you can claim depreciation in the year you place the property in service and in the year you disposed of the property. MACRS provides 3 depreciation methods under GDS and 1 depreciation method under ADS. The 200% declining balance method over a GDS recovery period, the 150% declining balance method over a GDS recovery period, the straight line method over a GDS recovery period, or the straight line method over an ADS recovery period. Table 4-1 lists the types of property you can depreciate under each method. It also gives a brief description of the method, including any benefits that may apply. To figure your depreciation deduction under MACRS, you first determine the depreciation system, property class, placed in service date, basis amount, recovery period, convention, and depreciation method that applies to your property. Then you are ready to figure your depreciation deduction. To help you figure your deduction under MACRS, the IRS has established percentage tables that incorporate the applicable convention and depreciation method. See Publication 946, Chapter 4, Appendix A for the MACRS Percentage Table Guide. Also, there is a MACRS worksheet in Chapter 4 of Publication 946 that will help you figure out your depreciation deduction using the percentage tables. Now, let's discuss listed property. Listed property is any of the following: passenger automobiles, any other property used for transportation unless it is an accepted vehicle, property generally used for entertainment, recreation, or amusement, or computers and related peripheral equipment unless used only at a regular business establishment and owned or leased by the person operating the establishment. If you are an employee, you can claim a depreciation deduction for the use of your listed property, whether owned or rented, in performing services as an employee only if your use is a business use. The use of your property in performing services as an employee is a business use only if both the following requirements are met. The use is for your employer's convenience. The use is for your employer's convenience if it is for a substantial business reason of the employer. The use of listed property during your regular work hours to carry on your employer's business generally is for the employer's convenience. And the use is required as a condition of your employment. The use of property must be required for you to perform your duties properly. Your employer does not have to require explicitly that you use the property. However, a mere statement by the employer that the use of the property is a condition of your employment is not sufficient. You can claim the Section 179 deduction and a special depreciation allowance for listed property and depreciate listed property using GDS and a declining balance method if the property meets the business use requirement. To meet this requirement, listed property must be used predominantly, more than 50% of its total use, for qualified business use. There is an exception for leased property. The business use requirement generally does not apply to any listed property leased or held for leasing by anyone regularly engaged in the business of leasing listed property. To determine whether the business use requirement is met, you must allocate the use of any item of listed property used for more than one purpose during the year among its various uses. Qualified business use of listed property is any use of the property in your trade or business. However, see Chapter 5 of Publication 946 for exceptions. If listed property was used more than 50% in a qualified business use in the year it was placed in service, excess depreciation must be recaptured, included in income in the first year it is used 50% or less. The adjusted basis in the property must be increased by the same amount. The depreciation deduction, including Section 179 deduction and special depreciation allowance, you can claim for a passenger automobile each year is limited. The passenger automobile limits generally do not apply to passenger automobiles leased or held for leasing by anyone regularly engaged in the business of leasing passenger automobiles. The passenger automobile limits are the maximum depreciation amounts you can deduct for a passenger automobile. They are based on the date you place the automobile in service. The maximum deduction amounts for most passenger automobiles for 2013 are shown in Publication 946, Chapter 5. If the depreciation deductions for your automobile are reduced under the passenger automobile limits, you will have unrecovered basis in your automobile at the end of the recovery period. If you continue to use the automobile for business, you can deduct that unrecovered basis after the recovery period ends. You can claim a depreciation deduction in each succeeding tax year until you recover your full basis in the car. Lastly, we will discuss determining the basis of assets. Basis is the amount of your investment in property for tax purposes. The basis of property you buy is usually its cost. The cost is the amount you pay in cash, debt obligations, other property, or services. Cost includes sales tax and other expenses connected with the purchase. However, you cannot include sales tax as part of your basis if you elect to deduct it as an itemized deduction on Schedule A of Form 1040. Real property, also called real estate, is land and generally anything built on or attached to it. If you buy real property, certain fees and other expenses become part of your cost basis in the property, such as real estate taxes, settlement costs, closing costs. If you purchase property to use in your business, your basis is usually its actual cost to you. If you construct, create, or otherwise produce property, you must capitalize the cost as your basis. In certain circumstances, you may be subject to the Uniform Capitalization Rules. The Uniform Capitalization Rules specify the cost you add to basis in certain circumstances. For additional information, see Publication 551, Basis of Assets. Intangible assets include goodwill, patents, copyrights, trademarks, trade names, and franchises. The basis of an intangible asset is usually the cost to buy or create it. The basis of certain intangibles can be amortized. Amortization is a method of recovering or deducting certain capital costs over a fixed period of time. It is similar to the straight line method of depreciation. To deduct amortization that begins during the current year, complete Part 6 of Form 4562 and attach it to your income tax return. For additional information, see Chapter 8 of Publication 535, Business Expenses. See Publication 551, Table 1, Examples of Increases and Decreases to Basis. There are many times when you cannot use cost as basis. For example, you cannot use cost as basis for property you receive as a gift or inheritance, or for property received in an involuntary conversion and certain other circumstances. In these cases, the fair market value or the adjusted basis of property may be used. Fair market value is the price at which property would change hands between a buyer and a seller, neither having to buy or sell, and both having reasonable knowledge of all necessary facts. Sales of similar property on or about the same date may be helpful in figuring the property's fair market value. On the screen is a listing of some additional resources that can be helpful when determining depreciation. This concludes the video portion of the webinar. We thank you for watching. If you would like to submit a question, select the Ask a Question link under the PowerPoint window and click the Submit button. Our subject matter expert is standing by and ready to answer your questions.
Hi, I'm Jerry Kelly Brenner with the Small Business and Self-Employed Division, and I'll be the moderator for the live Q&A portion of the broadcast. We hope you found today's webinar helpful and informative. Now, we are very fortunate to have with us today two senior program analysts. They are subject matter experts from examination policy, Marisha Heilman and Milton Pagan. Welcome to both of you. So let's find out what important questions we've received, shall we? Marisha, the first question is for you, having to do with documentation or record keeping, having to do with assets and depreciation. How long do we keep the documents for the assets we're depreciating?
Hi, Jerry. People should keep the documents for the asset as long as they own the property, and basically until it is disposed of, even if it is fully depreciated. There is a helpful worksheet on page 22 of Pub 946, How to Depreciate Property, that shows the types of records they should maintain. Things like the description of property, date placed in service, cost or other basis, their business use percentage, any Section 179 and special allowance that they have taken, any prior year depreciation, the basis for the prior year depreciation, the method, and things of that nature. Again, as long as they own the asset, even if it's fully depreciated, until they dispose of it. It's important to keep this information in the event that they sell it and they have any sort of a gain on the disposition of the sale of the asset, because they must generally recapture, which means included in income, as ordinary income up to the amount of the special depreciation allowance they deducted.
And the resource that you just mentioned, Marisha, that was publication 946?
Yes, it's entitled How to Depreciate Property. One thing I might add is that after the property is disposed of, they should keep the records for the length of the statute of limitations on the tax return that sale was reported on, which would be 3 years.
Okay, so 3 years after the date that they filed the return.
Yes.
That shows the disposition of the property. Am I understanding you correctly?
Yes.
Great. Okay, thanks for clarifying that. Milton, the next one has to do with, I'm sure many who are joining us today have realized, oh my goodness, I could have depreciated that. So what happens if they make a mistake and they didn't originally claim depreciation on property that they've now determined they can? What do they do?
Yeah, there were quite a few questions on that, I see. We're talking about two ways of making that mistake. Either you're putting down the wrong depreciation, or not putting it at all. If you had to claim that depreciation earlier and you didn't deduct it and you're entitled to deduction, sometimes you must deduct it, but sometimes if you can amend your return to collect and claim the correct amount of depreciation. This could be found. More information on that could be found in publication 527. If for some reason you fail to claim it and you cannot amend, you still have to correctly report what you depreciated. And by that I mean the amount that you did not depreciate, you could not be entitled to it currently. So you have to reduce your basis of the property by the amount of depreciation that you should have deducted. That does create some concerns. So in order to help you out, there's also another method, and that's not used that often, but you could also request a change in your accounting method. Therefore, sending in a request to the IRS and requesting a change, and we would either approve it or disapprove it. Not we, I mean whoever you send that to in Treasury. And that would probably give you an out as to how to take the proper depreciation.
So it sounds like amending the return would be a good way to go, because otherwise it's allowed or allowable depreciation that they would have to calculate when they actually dispose of that property. Am I hearing you that correctly?
You're absolutely right. So I would suggest, if you can, amend the returns to reflect the proper depreciation.
Oh, I would think so. Thank you. Marisha, I'm thinking that this person apparently uses a digital camera for their business. Otherwise, if it's personal, of course, it wouldn't be depreciable at all. But how many years should this person use for the length of the life of a digital camera for depreciation purposes?
Well, you are right about an item like that being could be used for personal purposes as well as business. This is considered listed property. Essentially, 5 years under MACRS, which is the modified, asset cost recovery system. 5 years would be appropriate if they predominantly use it for business purposes. That's more than 50% of its use is for business purposes. They can use MACRS, which using the 5-year recovery period and the straight line method. There's no Section 179 or special depreciation if it's not used predominantly for business. So the short answer is 5 years.
So 5 years, no Section 179 deduction, as long as, of course, at least 50% of it is used for business purposes. Okay, thank you very, very much. Milton, there are several questions, actually, about the Section 179 deduction limit for 2014. Many people apparently are aware of the fact that the 2013 limit expired and are wanting to know what the deduction limit is for 2014.
Well, I would love to be able to say that the 2014 deduction is X, Y, Z. Regrettably, it really depends on Congress. Right now, they're debating extending the various what they call extender laws on depreciation and depreciable property. There's 14 different types of extenders out there as it relates to assets and depreciation, and I'm sure Marisha has not heard anything on this yet. We're hoping that Congress does do something very soon because it is something that everyone is waiting on. So to kind of answer that in short, we don't have any information on the 2014 changes that might be possible. Otherwise, as you know, the extenders will be done, and we will go back to the pre-extender allocations and depreciable assets, such as the $500,000 and $2 million that we have now in the 179.
So it sounds like stay tuned is the response at this point.
Right.
Okay. Marisha, before we close the Q&A session, what are the most important points that you want the attendees to remember from today's webinar?
Well, as I'm certain that Milt would agree, this is depreciation is a very complex issue, and there is a lot of help out there for folks that need it. Of course, IRS.gov, there's a depreciation page. There are several publications that I find helpful. The first step in depreciation is essentially determining what the basis of the asset is, how much can you depreciate. So publication 551, Basis of Assets, is a very useful tool. In addition to that, there's publication 535, which is Business Expenses. It touches on some areas that we didn't cover in depth in the webinar, things like amortization, depletion, and also, again, I have said it a few times previously, publication 946, How to Depreciate Property, is an essential tool for everybody that deals with depreciation. And currently, the proper depreciation method for most property is MACRS, and people need to remember that. There are a couple of older methods. Prior to 1987 is ACRS, and I'm not sure that there's much out there anymore under ACRS, but also there's straight line and double declining balance methods. Those are explained in detail in publication 946.
Thanks, Marisha. Milton, is there anything you'd like to add to that as far as what you'd like the attendees to remember?
I like Marisha, agree that this is a topic that is not easy. There's a lot involved. You need to keep very good records. Depending on the amount of assets we're talking about and the number of assets and the amount of expenses, you may want to get a good accountant who will guide the taxpayer through potential deductions, the various assets, and the necessary schedules. Again, record keeping is very important. The basis is used to figure depreciation on the property and also to the gains and losses of the sale of the property. The original basis is usually the cost, but you will add or subtract to it depending on what's being done over the years. And again, that's why we need to keep the books and records for a longer period of time. And that's pretty much it. I can agree with Marisha, again, you have to determine the basis or your order or your intent to depreciate, and that the proper depreciation each year needs to be taken. But that, again, revolves around books and records.
Well, thanks, Marisha and Milton. That's all the time we have for questions today. Thanks so much for watching our webinar. We hope you learned a few things about depreciating your business assets, and whether you're a business owner or a tax professional, maybe this will open the lines of discussion. If you have any questions that were not answered today, please visit the IRS website at www.irs.gov using the keyword depreciation, as Marisha mentioned, and then there you'll find everything from a brief overview with the associated forms and publications that were mentioned to more in-depth information about depreciation and recapture, and even cost segregation in the related audit techniques guides. And with the laws and guidelines changing all the time, such as Milton was mentioning about the extender laws, to get the very latest delivered directly to you, subscribe to the IRS e-subscriptions. You have over 24 tailored e-newsletters that you can choose from, and all you need to do is just click on the down arrow next to the word subscription on the top right side of any irs.gov web page. And you can view a brief summary of each of the e-subscriptions so that you can choose the ones that are most important to you. If you do qualify, certificates of completion will be issued in approximately 3 weeks. And in case you'd like to review this information again or refer someone who was not available to view the webinar today, it will be posted in approximately 3 weeks in the IRS video portal at www.irs, V as in Victor, I, D as in David, E, O, S as in Sam, .gov. Thanks again for your time and attendance. Much success to you in your business, and we hope you have a great day.